So we all saw that news. The Bank of Canada did announce another rate cut of 25 basis points, and that pretty much brought the overnight rate down to 3%. Now this rate cut was very well priced in. There was not a major surprise. All the economists were on the same page and was likely going to happen. But what's going to be very interesting is how things pan out from here on as we head into the spring and summer of 2025, because as we know, we have so much of uncertainty surrounding the Canadian economy right now. One, we have a looming tariff threats from the south of the border. Secondly, we have the inflation data that just came out, which looks a little bit stubborn. Same with the unemployment data, which we're going to look at, and the bond market, which is all over the place. If you look at the 10-year Treasury bond yields for the US bonds, it's been wonky for the last few months. So we're going to look at all that data and we see what we can really make out of that data for the real estate market and for the broader economy as we head into the spring and summer of 2025. So stay tuned and let's get right into it. Hello and welcome. If this is your first time to this channel, be sure to subscribe and tap on the bell so you are the first to learn about the current market in and around Kitchener-Waterloo. My name is Dharmik Dixit and I am a local real estate agent serving Kitchener and surrounding towns. And I have people just like you who reach out to me looking for help in making their move in and around Kitchener-Waterloo, and I absolutely love it. So whether you are thinking of moving in 9 days or 9 months, be sure to reach out. You can call me, text me, email me, or even schedule a Zoom call. All the info is right below in the description. I'll be more than happy to help you make a smooth move in and around Kitchener-Waterloo. So if you look at that press conference that happened during that rate announcement, a couple of things that were the key highlight. One is the rate cuts moving forward. It's going to be very slow and gradual. So we're not going to see back-to-back rate cuts. I mean, the one that happened just now was the 6th consecutive rate cut by the Bank of Canada. But we're not going to see that happen moving forward. It's going to be more slow and gradual. Maybe we won't see another rate cut in the month of March. Secondly, the Bank of Canada governor is equally concerned about the looming tariff threats on us from south of the border. And that could happen anytime. We don't know in what shape or form that will happen. But what we do know is the fact that the impact of that tariff on the Canadian economy could be devastating, and it could really push Canadian economy deep into the recession. I'm not trying to sell fear here, but that's the unfortunate reality that we do depend very much on the US for our exports. I mean, I think that's our biggest trade partner, but not only that, our reliance on them is so much that I think 3 out of 4 items that we sell it to US. So it's going to impact us dramatically. And the tough part is the fact that the Canadian economy right now is already struggling. Let's take a look at the inflation data and the unemployment data that just came out a couple of weeks ago. If you look at the inflation data, it was down from 1.8 to 1.7 in the month of December. So yeah, you might see, okay, it slowed down a little bit, barely any much. But you know why? Because of the GST break that was given to us by our very nice Prime Minister. I won't get too political right now, but due to that GST tax break for the month of December and January, that brought the inflation data down. So you can almost say that it was artificially brought down the inflation numbers. If you were to take that GST break out of the equation, the core inflation was at 2.3%. So it's very much within that comfort zone of Bank of Canada. They're more than comfortable with that hovering around 2%, whether slightly above or below 2%. It's not a major deal breaker or a concern for Bank of Canada to starting to raise the rates or do anything crazy. But what's worth noting is the fact that inflation is still very much stubborn. It's not coming very much down that dramatically, despite back-to-back rate cuts and, like I said, 6 consecutive rate cuts. Now let's take a look at the unemployment data. For the month of December, unemployment data that came out just a couple of weeks ago, we had 6.7% in the month of December, down from 6.8 just a month ago. So you can see again, even unemployment rate has not significantly come down. And part of the reason for that is Bank of Canada, just before this rate announcement in the month of January, did a survey. They did survey some businesses in Canada and they did survey some consumers in Canada to see what kind of sentiments they're having. Has it gone up or down, overall sentiments in the market? So consumer sentiments were up. So that was a positive sign. On the other hand, the business sentiments were very much down. And the major reason that was cited was the fact that the tariff threat that's looming on the Canadian businesses is really making them anxious and uncertain about how they can plan for this year. And that's why we don't see a lot of business investments that's happening. Despite the rate cuts, business borrowing is not spiked up as much, and it goes hand in hand with the unemployment, because if there's no new projects and new business investment that happens in the economy, if there's no new capital that's flowing into the economy from businesses, there is not going to be more jobs being created by those businesses. So it does go hand in hand. And that's why, like I said, the unemployment rate, at least in my opinion, I would say it's very much stubborn and we have a bigger problem at hand. And that's part of the reason Bank of Canada did go ahead. And I can say this 25 basis point rate cut, in nature, it's almost stimulative. It's to basically push the economy a little bit upward, to create a little bit more jobs, to create a little bit better business sentiments so we can see more capital flowing into the market. So that was the reason behind that rate cut. Now you might ask, what about the housing market? Well, I would say for the month of December, housing market was pretty much stable, and in fact the activity has dramatically declined. Now I don't want to send any red flags here because that's typically the seasonal thing for the housing market. In any market, not just KWC, you typically see December, January are really slow in terms of overall activities, transactions, volumes are all down. And then come February, more so in March, we start to see things pick up. And that's gonna be the case. You can check out the full video I did where we looked at all the graphs for the Waterloo real estate market for the month of December. You can see it was all down. You can check out this video right here. But overall housing market was also down. Part of the reason for that is the fact that the affordability is still a problem. I mean, we saw the bond market. If you look at the 10-year US Treasury yields, they're hovering around 4.5%. So for the past few months, it has shot up, and that has pushed the fixed rates further up. So they are no longer in that high 3, low 4s territory. They are more so in the mid 4s territory. So, it's very uncertain. It's been hard to predict as to where the bond market is heading. And, especially at some point this year, I feel like we will reach a point where fixed and variable will basically at the same level. And that will be a crucial decision point for many people looking to buy or refinance as to whether to go for fixed or variable. My personal take, again, not a financial advice, but my personal take is to go with variable if you're comfortable with somewhat little bit fluctuations, because likely if the tariff was to play in some way or put on us in some way, the Bank of Canada might have to step in and stimulate the economy. And that could push the overnight rate down all the way from current 3% all the way to 2% or even low to 1.5%. That might be the case. We don't know yet, right? But yeah, work with your financial advisor or your mortgage agent who know, or hopefully I do. I hope they do know how these things are all connected together and they can guide you the right way. But that's a little bit about the bond rate and the housing market. And you can see the affordability is still a problem. Part of the reason is also the fact that the inventory is still very much controlled. I don't want to say it's a seller's market, but it's pretty much a balanced market. We're not seeing a lot of inventory coming out. And even if I'm working with a few sellers, and the way we approach it is we sell first and then buy, we don't do it the other way around. So if sellers are not getting the price they want or they're not getting the response on their listing, guess what? They'll just cancel and not sell. They will postpone their plan to move for now rather than selling it at a loss. So you can see the inventory is limited. Not that many buyers are out, but guess what? There are not that many sellers are out in the market either. So the inventory is pretty much controlled and balanced. Same with the new builds. Well, there are definitely some new builds available, and builders are giving some good discounts, good incentives, but they're not releasing 100 lots at the same time. They release 5 or 10 lots, maybe 15 at a time, depending on how big the subdivision is. And that's how they control the inventory and the prices. So that's what I would like to say. It's pretty much a balanced market when it comes to real estate. Now that does bring us to our next question as to what you can really expect of all this data and of all this uncertainty as you head into the spring of 2025 for the real estate market and for the broader economy, which is in general, spring and summer for the real estate market is supposed to be a busy time of the year. If you look at historically, even during those down years, past couple of years, spring was the busiest time where the prices peaked to their most in those particular years. I mean, that might just be the case for this year as well. I don't think we will see just a completely down market. We will definitely see more buyers and sellers come in the market come spring and summer. Typically from spring to fall, we see activity and transactions and volumes in general will pick up, and then it will start to slow down. So that might just be the case, but with so much of uncertainty around how President Trump will, play out those tariffs and how those things will affect the Canadian economy, it's going to be very uncertain. If this was not in the equation, this tariff threat, we were all hoping for a good real estate market and a, economy eventually rebounding towards the later part of this year. But now with the tariff threat that's looming on us, honestly, it's very hard to predict as to where every part of the economy will head into and how it will overall respond. The Bank of Canada governor himself did say that it will really test the resilience of the Canadian economy, and it could potentially push us into the deep recession if those tariffs were to come into the play. So that's where we have to look at closely. And if you want to, I am going to look at closely and report here right on this channel. Be sure to give it a thumbs up, subscribe to this channel, and tap on that bell so you are the first to learn about the current market in and around Kitchener-Waterloo. And I will leave you with this. If you're a buyer in this market, then I would say definitely have 3 to 6 months of money saved up. That's your monthly cash flow. 3 to 6 months, at least that much saved up in your bank account besides your down payment before you pull the trigger and buy a home. Now, if you're a seller in this market, I would say patience will be the virtue, and that will play out very well. But more importantly, you have to be on point with your pricing and offer strategy, how you want to approach it, and marketing is going to be the key to sell the home. It's no longer selling just by putting this yard sign out of your home and you're getting multiple bids. Well, that's no longer happening. So just be mindful of those things and plan things out accordingly. Like I said, it's a fairly balanced market. It's a good time to buy. I would say more kind of leaning towards buyer, because this kind of time did not exist for a buyer for the last many years. So this could be a good time. But it's going to be a very interesting year nonetheless, and we're going to track it right here on this channel. I'm in fact going to come out with another video about the market report in the month of February. So be sure to subscribe so you are the first to get notified when the new video pops out. Until next time, well, I do hope to show you around town.